Good morning, everyone. This is Rick Lang. I just want to thank you for joining us. It's exciting today to be able to present our team here at Hall & Company. The topic today is going to be on the TIGTA report and its impact on the cannabis industry, including its identification of how small businesses could be able to include 100% of their expenses, including advertising, administrative expense, and the cost of goods sold. I'm blessed to have Simon DeFurs, who's an audit principal with us at Hall & Company. For those of you who don't know Hall & Company, we're a full-service CPA firm that provides all the services of a Big Four national CPA firm. Approximately 70 professionals, but our expertise is, deep, and we perform audits, quality of earnings, reviews, taxes, state and local R&D taxes, cost seg, international taxes, just a full platform of offerings that you would see at other firms. On the larger level, we have got just one office here in Irvine with a little overhead, no national firm expenses. Normally our cost is much more competitive than others. And the good thing is we are part of the BDO Alliance, which gives us all their white papers, their research, a number of different sources to help us, obviously, as we grow this business. Simon DeFors is a audit principal with Hall. We have been serving in the cannabis space since 2014. As the cannabis practice leader, Simon stays pretty close to the cannabis community. He's taught continued professional education to CPAs and attorneys on 280E, banking, and how to service the cannabis industry. Simon was also a presenter on the Cannabis Business 101 course at the NCIA conference, was on the first ever ACG OC Cannabis panel, and is a founding member of the Cannabis Society virtual conference, and has presented on numerous webinars and podcasts, including Mary Jane, My Story, and The Cutting Edge of Cannabis. And joining him will be Jeff Elkins, has been practicing for over 10 years, has a master's in taxation. He heads the firm's cannabis tax compliance and technical planning efforts, and has published numerous articles in the industry over the years. I'm excited to listen to the presentation and both Simon and Jeff's presentation today. With that being said, Simon, here we go. Simon DeFurs.
Thanks, Rick, for the propaganda intro. Wow, this is awesome. We're excited to be here. We're excited at the turnout here. I'm looking at the list, and there's really numerous clients that we have, companies that we've been talking to, including multi-state operators, publicly traded, well-known companies, small verticals, all the way down to one location dispensaries. We've also got a lot of other business professionals, including other CPAs, actually quite a number of other CPAs, which we think is great. I've said it a million times, and it's the reason I teach continued professional education to other CPAs. The more professionalism and knowledge we bring to the industry, the more it will thrive and be legitimized. So why are we here? About 2 months ago, the Treasury Inspector General, let me move these slides forward here real quick. About 2 months ago, the Treasury Inspector General, or for Tax Administration, or TIGTA, released a report on a study they conducted on the marijuana industry 2016 federal tax returns in 3 states, which were California, Washington, and Oregon. The report listed 6 recommendations to the IRS, and there's 2 key takeaways from those recommendations. The first one is not really good news. They really upheld 280E, and for a lot of reasons, we believe that there's going to be significantly more audits coming, and we'll go through those. But the interesting one is one of these suggestions really kind of exposed what people in the industry are calling a loophole. I personally don't like to call it a loophole because technically 280E still applies, but there is potentially a way for small business entities to deduct 100% of their business expenses as cost of goods sold, including advertising and sales and marketing expenses and administrative expenses. So that's exciting. If you guys have seen any of my podcasts, I get fired up when I talk about 280E. The 3 words I typically use are that it's unfair, diabolical, and unconstitutional. So over the last 2 months, when Jeff and I read this report, you know, we reread it again, we reread it again. We started scouring the tax code. We started arguing with each other. We started sending each other questions at 2 in the morning. We started discussing it with other partners in our office. We started discussing it with BDO partners from the BDO Alliance that we're part of. We started listening to other industry leader webcasts, including one that is actually on our webcast today. Nick, thanks for joining us. So as a result, we believe that there is a significant argument that that is backed by the tax code that small businesses can include 100% of their expenses in the cost of goods sold. And we'll get to that, but I think first it's important to understand the background of how we got here. So maybe Jeff, you can talk about who is TIGTA and why should we care?
Sure. So TIGTA was established to provide independent oversight and serve as an inspector general for the IRS. And their mission is to promote the fair administration of the federal tax system and work to ensure that they're held accountable for all the trillions in tax dollars that they collect in revenue every year. So when we talk about this report, it's really the result of an internal review of the IRS's own examination and educational approach to the industry. And Simon mentioned the findings, which we're going to get through in the next couple slides, and particularly this loophole. But really, its inclusion in this report really highlights its significance and helps underscore that this is a legitimate issue, right? If this was just some crazy idea or an obscure interpretation, it wouldn't be in this report. Like many other things, right? They didn't talk about the constitutional challenges to 280E. There's a lot of things they didn't talk about. So again, its inclusion here by a Treasury agency in a report to the IRS just underscores the significance and the fact that the IRS thinks that there's something to this.
Yeah. So what TIGTA found was that the vast majority, almost 60% of businesses did not apply 280E correctly or even at all. And what I can tell you is what we found in this report is really consistent with the tax returns that come across our desk. We frequently find that people are not applying it correctly, and you'd be surprised how many times they're not applying it at all. They found an estimated 48.5 million of underpaid tax liabilities is what they estimated. They projected that out to 242.6 million for 5 years. And you got to remember that this projection does not include just the explosive industry growth, especially in California. California sales have significantly increased since 2016 with the legalization of recreational use. And remember that this is just in 3 states. We're up to 34 states where it's legal if you include DC, and 11 recreationally. So what does it really mean? It means that the IRS believes that the audits of marijuana companies are extremely profitable. That means the return on hours spent on auditing a cannabis company is significantly more than the return on hours spent of auditing a non-cannabis company. The IRS compliance approach on the marijuana industry does not include leveraging state data available to identify businesses for possible audit selection. So we'll go into this a little more as well, but what's going to happen is, at least the recommendation is that the IRS tap into the state's licensing systems in order to identify companies' businesses to audit. Some unbanked marijuana businesses are assessed federal tax deposit penalties based on non-electronic funds transfers. So a lot of cash transfers can have significant penalties associated with them, including filing your Form 8300. And this last bullet point is really the finding in the report where we were most interested in, which was the IRS lacks guidance regarding the Internal Revenue, the IRS Code 280E, and the uncertain impact from the IRS Code Section 471C of the Tax Cuts and Jobs Act.
Yeah, so Simon kind of hinted on earlier that out of this report, TIGTA identified 6 recommendations to the IRS. And they're up, the first 3 are up there on the slide. I'm not going to read them verbatim, but you look at those first 2, they talk about a comprehensive compliance approach. CIP stands for Compliance Initiative Project. And the second bullet point there, examination areas using aging reason codes, which is basically just a way the IRS tracks audits so that findings can be shared. And what they're looking at here is they're trying to develop a consistent approach so that, one, you have consistency from audit to audit, because that's one thing that the industry is facing right now, and anyone who's been audited can tell you this, is that each, depending on the examiner that comes in, you're gonna get different results. So consistency is something they're trying to do, and then also tracking so that agents can compare their audit to other audits, and again, just get a unified approach, which really is going to be good for the industry. It's going to really help with the ambiguity, because you don't have one agent saying one thing and someone else saying another. That third bullet point there, recommendation 3, is really in the area of educational outreach, right? Developing a frequently asked question or some other sort of educational material for the industry so that operators and tax professionals can use that as a resource when they have questions on marijuana industry returns. And then moving on to the next 3 recommendations. So this is where we get into the bad side of things. Leveraging those state information databases. They identified that as an easy way to identify non-compliant taxpayers. So that's kind of in the line of more audits are coming. Simon mentioned these audits are extremely profitable on a dollar per hour basis. They're higher than most, if not all, other industries. So to the extent that they can identify and examine more marijuana companies, it's increased revenue for the Treasury, and they look at that. They look at these sort of things. And then number 5 as well. That's more on the educational outreach side, helping taxpayers avoid penalties and just making sure that there's information for the industry. So really, there's good and bad coming out of this report. And then finally, recommendation 6, that is, as Simon mentioned, for the IRS to provide clarity on the application of this new Section 471C that came out of the Tax Cuts and Jobs Act for the 2018 tax year. And one important thing to note here is that when TIGTA made these recommendations to the IRS agreed with the first 5, right? So yeah, they agreed that there's money left on the table. Increasing our audit efforts is going to increase collection. They also agreed that they haven't really been forthcoming in the educational outreach department, and that they're going to try to make more information available to help taxpayers comply with the law. So they agree with those first 5 recommendations. Clarity on this 471C position, they disagreed, and their excuse was that they don't have the time or the resources to do that. But our opinion is that that's really kind of almost a cop-out in a sense. They could have easily said, look, we don't interpret this way and just shut it down right there. But I think that they really are taking a different approach here, and they're going to want to take this to tax court and pick and choose cases that they might think that they can win, because if you just look at it on, just by reading the code, as we'll get to here in a second, it's a pretty clear interpretation, and that's the opinion we've gotten of a lot of other professionals that we've spoken to as well. So really, what I think they're looking for there is they're going to look for someone who's trying to take this position and maybe try to take shortcuts. They're not going to dot their I's and cross their T's, and we'll get into some of the ways that you can help mitigate that risk. So accounting for inventory. Why do we care about inventory, right? Inventory is important because, you know, as we know, Section 280 bars the deduction for any operating expenses except for the cost of goods sold. And of course, cost of goods sold is derived from inventory. So when we talk about inventory here and we talk about, you know, a change in accounting method for accounting for inventory, what we're really talking about is how do we deduct a cost as cost of goods sold? And the vehicle that we do that with is inventory. So looking there at Section 471. 471 governs the inventory accounting rules for the IRS. And that next bullet point there, 471A, this is taken with a little bit of paraphrasing there, directly from the IRS code. So I'm just going to read this section here. When the use of inventories is necessary in order to clearly determine the income of any taxpayer, inventory shall be accounted for on such basis as the Secretary may prescribe. So what does that mean? It means the IRS dictates how taxpayers account for inventory, and the regulations go to great length in order to do that. You know, you've got 471-3, 471-11. There's 263A, which of course doesn't apply to cannabis, but there's a lot of information on what's an inventoriable cost and what's not. But even still, there's ambiguity, right? Because when they wrote these, they didn't write these regulations with cannabis companies in mind. And for most people, for most businesses, it doesn't really matter too much, because whether it's included in inventory or not, that just means they're going to deduct it as a regular trade or business expense. And it's a timing issue. Is it a deduction today or tomorrow? But for cannabis companies, it's not a question of timing. It's a question of, will you ever get to deduct this expense? So that's why the focus on getting as much as you can into inventory is important in the industry, because if it's not an inventoriable cost, that deduction is lost forever. So that's the, you know, we'll say the old way, and that still applies. But the Tax Cuts and Jobs Act did identify, did add a new section, Section 471C, and that's where this, you know, this new interpretation comes from. So what 471C says is, it says that you don't have to follow Section 471A. And remembering back to that last slide, 471A says the IRS prescribes rules for accounting for inventory. So they say you don't have to follow those rules for inventory, and instead you can use an accounting method for inventory that conforms to the taxpayer's method of accounting reflected in an applicable financial statement or the books and records of the taxpayer prepared in accordance with the taxpayer's accounting procedures. So again, what does that mean? It means that you can use a method of accounting for inventory that's consistent with your books and records. So unfortunately, if you have a financial statement audit, that would fall under the applicable financial statement category. You're going to have to follow your audited financials. So of course, if you're having audited financials, they're going to be either compliant with GAAP, or if it's an international or publicly traded company in Canada, maybe IFRS, but you're going to have to follow GAAP or IFRS. So this isn't necessarily going to work if you have one of those applicable financial statements or some sort of formal GAAP financial statement. But if you don't have an applicable financial statement, and this is going to be a lot of companies, right? So there are some, you know, some jurisdictions do require audits for dispensaries, local dispensaries, for example. But if that's not a requirement, and you don't otherwise have audits for, you know, debt covenant reasons or investors or those other areas that you would commonly see for an audit, then you can use a method that's reflected in your own books and records and according with your own accounting procedures. So the idea here is that there's really nothing stopping someone from setting up their own internal accounting procedure in order to include every expense as an inventoriable cost.
Yeah, Jeff, and one point, like you mentioned, you know, various jurisdictions might have different rules and regulations. For example, you know, Arizona, the entire state requires all licenses to get audits. So if it's a cannabis company in Arizona, it's almost automatically not eligible for this. So just real quick, I'm going to do a real quick polling question, kind of gauge about the size of the companies that are on the call today. Okay, so we got a fair amount here of small business entities. It looks like there's about more than half are less than 25 million. There's a small percentage that's greater than 25 million, 8%, and there's 37% don't have cannabis companies. A lot of business professionals on the call.
And I think, Simon, I mean, I think you would agree. That's really been our experience too, is that you know, a lot of the companies we're working with are, you know, they're in the startup phase, or if they've moved past that, they're really still trying to grow their brand, and they're, you know, trying to put themselves in the best position possible for when legalization happens, and you know, federally anyway, and then you see maybe the second boom. But anyway, back to what we were saying with this books and records, right? So really, what we would need to do in order to adopt this method, and you know, we can talk about this, you know, when we get into risks as well. But setting up internal accounting procedures that, again, include every expense that the company incurs as a component of inventory. And what would then happen is, as that inventory is cycled through, all of those costs are going to hit your cost of sales, and you're going to end up with a deduction for 100% of those expenses, and there's going to be no 280E add back, which you know, I don't have to tell you guys is significant. And that sounds great and all, but there's a couple of catches, right? Who qualifies? So a qualifying taxpayer is any taxpayer other than a tax shelter who meets the gross receipts test, which it started as 25 million, but it's indexed for inflation. So currently for 2019, it's 26 million. And that's calculated as an average over 3 years. And, you know, if it's different if you have a short period or if you just started operation, but you know, those are some of the details you'd have to look at on a case-by-case basis. So, you know, the big takeaway is you know, are you close to or under that 26 million mark? And then another qualifying criteria here is that if this is not a method that you're currently using, which you know, I would say is probably everyone, then a change in accounting method is required. And this goes into what I said earlier about, right, dotting your I's and crossing your T's. This isn't just something you just throw on your tax return and just hope it sticks. The taxpayers who are successful in implementing this and defending it in audit or defending it in court are going to be the ones that really, you know, documentation is always key, but really who follow the letter of the law and who follow a set of best practices that really align with what the code is saying here. So it's getting that change in accounting method filed. That has to be done on a timely filed tax return. So that's something that can still be done for 2019 if you haven't filed yet. And even if you have filed, there's options for superseded tax returns potentially to still get that on as long as it's before the due date. So that's an important piece there. And then two other things I'll briefly talk about here, and maybe they're both subjects maybe of even their own webinar, but we talk about who qualifies any taxpayer other than a tax shelter, right? So that's, you know, I kind of glossed over that, and for the most part, we don't think of you know, operating companies as tax shelters. We think of tax shelters, we think of tax evasion, but there is a special carve out there for this gross receipts test, and it's the inclusion of the syndicate rules, and just a high level thing of what to be aware of in these syndicate rules is anytime you're allocating losses of greater than 35% to members who don't participate in the company, either in management or operations, that's when you might have an issue. So this is actually something seen really common in real estate. You have a bunch of passive investors, and really they're not really operating or managing the company at all. You kind of see this come into play there. So, and we've seen it a few times in cannabis as well, where the company has built out its investor pool and those investors aren't participating. Well, if those investors have significant enough equity, that can really kick you out of this by putting you into that tax shelter bucket. There's ways to deal with that and to mitigate that. So, if that's something you think you might be subject to, definitely reach out and we can discuss. But the other thing I want to talk about is that gross receipts threshold, the 26 million. You are required to aggregate. And what that means is if say you operate 3 companies in the cannabis business or cannabis industry, and each one of those companies has gross receipts of 10 million, on a separate basis, they're all under that 26 million threshold. But because of these aggregation rules, you're required to count those together. So you're at 30 million, and then none of them would qualify. And the aggregation rules, again, they also get pretty complicated, but generally, you're talking about entities that are under common control, which would be a greater than 50% ownership, or you have affiliated service groups, parent, sub, brother, sister, control groups. So just big picture takeaway is if you're operating multiple businesses, you may be required to aggregate those gross receipts for purposes of this $26 million threshold.
Yeah. But there is a question. If applicable financial statements, if there's multiple of them, and in total it's less than 25 million, can you apply this to one of your subsidiaries that doesn't have an audit, and we have another subsidiary that does have an audit? For example, if you had operations in Arizona and California, in total it was less than 25 million. Could you apply it to your California operations where you don't have an audit, and not your Arizona operations where you have an audit? And the answer to that is yes. You would be able to aggregate them. You would be able to do it for one of your subsidiaries that does not have an applicable financial statement. Right. And another way to say that, you're required to aggregate your gross receipts. You're not required to aggregate your applicable financial statement for that test, right? So that's applied to each separate entity, the financial statement test. Yeah. Anything else on that one, Simon? Or are we moving on to our final points here? So, our final points here, but Jeff, is a change in accounting method a red flag for an audit? It's not, and in fact, I don't even know the number. Personally, we filed dozens and dozens last year for a variety of industries, right? Because when this Tax Cuts and Jobs Act came out, there were some big takeaways, right? And this is one of them, right? It's accounting for inventories, the use of the cash receipts method versus accrual. There's a whole slew of changing accounting method for depreciation. There's any number of reasons that a taxpayer would change their accounting method, and that in and of itself is not any sort of red flag. It's pretty common, in fact. And one thing to note about the particular type of accounting method that we're talking about here, there's really 2 types. One would be the type of accounting method change that requires prior consent of the IRS. And then there's the other type, which is an automatic change in accounting method, which requires no prior consent. So the change we're talking about here to apply 471C is an automatic change, meaning you don't need the IRS's approval. As long as you file your change in accounting method on time, that change is granted automatically. And so, we say don't call it a loophole because 280E still applies. This isn't a challenge to the legality of Section 280E. There have been court cases on that. One as far as to the Supreme Court last year, or it was last year, maybe late 2018. But anyway, they upheld 280E. There are still
those out there that think there's maybe other venues to potentially invalidate 280E, but that's not what we're talking about here. What we're talking about is, again, an inclusion of expenses in inventory, which then flushes through cost of sales. So you're really compliant with 280E because under 280E, your only deduction is cost of sales, and that's what we're talking about. So, again, we're not circumventing 280E, we're really just mitigating its effects. And then, the IRS silence is deafening. We kind of talked about this earlier with their, that recommendation from TIGTA to the IRS to provide clarity here, and their response basically that they're not going to. Their silence here, again, really kind of tells us that they don't, on one hand, they're not going to say, yeah, that's a valid interpretation, go ahead and do it, right? Open the floodgates, just everyone go for it. But at the same time, I think they're being careful to take a position in saying that it doesn't apply, because I think that they know that there's enough credence here that someone's going to challenge this. And again, when the IRS looks at these sorts of things, here's how it's going to go, right? Returns are going to get selected for audit. Then depending on, and it could stop there, right? The examiner could say, yeah, look, that's a fair interpretation. We're not going to take this any further. You guys, you basically win the audit. I think that it's probably not going to be that easy. I hope it is. But if the examiner disagrees, you take it to the next level, the appeals level. And at the appeals level, what they're looking at there is that they're weighing the hazards of litigation. So because after appeals, the next level is tax court. So when you have a case in appeals, they're either going to make concessions because they think that that this is either a valid position, or maybe they're trading horses, right? Maybe they're not going to give you the full 100%, but they give on a few items, so it's still a net win. And even if you disagree from there, you can take it to tax court. But the cases that the IRS likes taking to tax court are the cases that have bad facts, right? So maybe the taxpayer didn't have a written accounting policy, which is something we recommend to anyone who's considering taking this position, is have a formal written accounting policy that says we are including all of our costs into inventory. Sign it, date it, put it in your file. Something easy like that. It's making sure that change in accounting method is filed and is filed on time. It's the things like that. It's making sure that your books and records are prepared in accordance with those accounting procedures that you set forth. So it's really a work on the back end to make sure that if you do get to that audit stage, that appeal stage, or even take this to tax court, that you have all your ducks in a row, and this is a case the IRS isn't going to want to fight you on, right? They like easy cases, they like easy wins. So don't make yourself a target, and have all these things in place. So moving on to the next one there. I mean, Simon, do you have anything to add on that?
No, I think that's right on point. And just like everything else, when we prepare, even in applying 280E, there's still a gray area. And whenever we prepare a tax return, we tell our clients, hey, this is kind of the gray area, and different IRS auditors can come to different conclusions. So it has to do with your level of risk appetite as well. We think that there is a significant leg to stand on to take this position, but again, it hasn't been proven in tax courts. And to Jeff's point, that's going to take a little bit of while to play out.
Right. So a lot of questions we've gotten from clients as we've started to talk to them about this is this one right here: can I amend prior years? So this, we mentioned, was a change that came out of the Tax Cuts and Jobs Act. So 2018 would have been the first year that this would have been a possibility. But because of that requirement to file a timely change in accounting method, you can't go back and amend prior year return to do that. Really, if you haven't implemented that method already, 2019 is going to be the first year. And then, on to the next one. How do I implement this? Well, if it's your first year of business in 2019, no change in accounting method is filed. You can just adopt that method going forward. But if you've been operating for any period of time longer than that, you'll need to change the accounting method in place. And again, get a written accounting policy that outlines the the position you're taking. All expenses are included in inventory, and it's preparing your books and records in accordance with that policy. That's really how this is implemented. And then on to the next one. What are my risks? So, despite the fact that, Simon and I and pretty much everyone else we've talked to in the industry is very excited, very positive about this interpretation, that's not to say it's without risks. So, if we go back, Simon, go back 2 slides. Or no, maybe go back 1 slide. Yeah, this one right there. So when we look at this, and again, this is right from the code, there's really only a couple of sentences that are really the crux of this whole thing. So we say we're accounting for inventory using a method that conforms to the taxpayer's method of accounting reflected in the books and records of the taxpayer prepared in accordance with the taxpayer's accounting procedures. That's really, 2 sentences. That's what we're talking about here. If you read that, you read it again, it seems clear that you can, as long as you have an accounting procedure that would put everything in cost of sales, the IRS says that that method that you adopt will not be viewed as failing to clearly reflect income. So, again, that's in the code, but that's really all we have. There are no court cases. There are no private letter rulings, chief counsel advice. There's no regulations. Really, that's really it.
No,
there's no risk here.
The IRS specifically remained silent on it, right? I mean, they specifically said we're not going to say anything about it because the tax code speaks for itself.
Yeah. So to say there's no risk here, I think would be foolish. But again, it's important to proceed with caution and proceed with following a set of best practices to make sure that if you do get selected for audit, that you're in the best position you can to defend that position. And a few other things we talk about on the risk side, right? So we have audit risk. The question of whether or not taking this position increases your risk of audit, which the IRS has no information on this or not, but I would say that it probably does, because either one of 2 things is going to happen. You're going to have a cannabis tax return with no 280E add back, or if you're disclosing this position, which we believe is a good recommendation to disclose. If you're disclosing this position, you're basically saying, hey, look, here's what we're doing. We want to be transparent. We want to be we want to be in compliant with the law. We believe this is a fair interpretation, and here's what we're doing. So does that increase your risk for audit? It might, yeah, a good chance it does. But back to some of the other takeaways from the report, as a cannabis company, you are already at a very high risk of audit, and that risk is really only going up as the IRS develops better procedures for identifying and selecting companies for audit.
Yeah. And one of the reasons that it's important to disclose that the position that you're taking is that if the IRS does come back and say, hey, we don't agree with this position, you're not going to be charged penalties.
Right. There's a 20% accuracy related penalty that would potentially apply here. But by disclosing the position on your return, you mitigate your risk of that 20% penalty. So we believe that that's a good recommendation. And you hear too that the IRS also does, they waive that penalty, sometimes on their own, but really, we believe that you wouldn't want to rely on an IRS exam agent to, basically relying on their grace, because there's no requirement that they waive that penalty. And they can challenge that all the way to court with you. So the only statutorial way to hedge against that 20% penalty is to disclose the position on your tax return.
Yeah. So we've got a few questions. I'm going to move through a couple of them. Will moving from GAAP accounting to an in-house accounting method have a negative impact when potential buyer enters into due diligence? I don't think so. Obviously when the potential buyers come in, they usually do a quality of earnings report, and they have their there are adjustments to what the internal financial statements are anyways, you know, and EBITDA add backs and other things that they might not want to include in there. So they're going to go through and dissect anything as it is. Another question for Jeff is how do we get around the flush language in 263A?
Well, so the beauty of this is that we're not really talking about 263A. So the flush language in 263A says something to the effect that this section of the code, 263A, be used to add in, basically to allow for a deduction of a cost that wouldn't otherwise be deductible. So one, we're not really dealing with 263A here. We're basically bypassing it completely. But again, we're not necessarily, well, I will say that section 471 doesn't have that same flush language. And by treating all these costs as inventoriable costs, we are, you know, we're deducting them through costs of sales, which, you know, there's no prohibition on cost of sales deduction. So I really think that the 263A is, you know, a non-issue here.
Okay. Will this present, will change in accounting principle, will it present an issue when cannabis is federally legal? I don't believe so at all.
No, it wouldn't at all. The question you would ask yourself is this a method we want to continue now that we don't have to anymore? You know, you may decide that you want to change back to a more traditional method, and you can do that. You can change your method back and forth. You know, there's some requirements to that, but it's generally not a big issue. So yeah, no, this wouldn't be an issue with legalization.
And here's an interesting one. We're focused on cannabis industry for this webcast, but is the loophole, quote unquote, applicable and beneficial for other industries for any small business that sells goods? And the short answer is yes. I mean, the whole point of putting this in the bill had nothing to do with cannabis entities, but it had to do with relieving small businesses of the burden to delineate between cost of goods sold and really go through the tax code and have difficult internal accounting procedures, and just doing it as simple as they wanted to do it.
Right, and to expand on that, you know, a more traditional industry, you know, say a widget manufacturer, would potentially apply the same provision, 471C, but they would probably do it in a different way. So, for example, here in cannabis, what we're trying to do is we're trying to take the position that everything is an inventoriable cost. So we're going to dump everything into inventory. A manufacturer of widgets might do the opposite. They might say, look, we don't want to deal with inventory at all. We're just going to flush these as just regular operating expenses. And that's really what, you know, what we've seen a lot, as, you know, I don't know if you call it the intended approach, but really just relieves people of that burden of inventory accounting. So yeah, again, a traditional industry would still benefit from this, but maybe in a different way.
Hey, how about seeking a private letter ruling?
Yeah, I mean, I would love for someone to do that. Private letter rulings are expensive, very expensive. You're talking, you know, $20,000, $30,000 at least for a private letter ruling. I hope that someone does that because, again, those become public. They're not what's called substantial authority to be relied upon, but they do give an idea of what the IRS is thinking. So to the first person who does a PLR, kudos.
Yeah. Here's an answer to another question. As far as I know, there is no language in Congress committee discussions to add color to their intentions of 471C. I have not heard anything to that effect. How does this affect companies that already have their cost of goods at 80% of sales? I'm assuming that's a cultivator. Well, whatever expenses you're not currently expensing, you can add to that, or currently deducting. Right. So if you have advertising and administrative expenses, which is probably the two expenses that cultivators don't put up into cost of goods sold, we could do that going forward, and that's the whole point.
Right. You know, and again, 100% is better than 80%. But you're right. I mean, this has less of a benefit for cultivators because cultivators already have the ability to deduct more expenses because the rules for inventoriable costs are more favorable for producers than they are for resellers. But I will say that I think it would still, I don't see why a cultivator still wouldn't take this position, even if the dollar amounts are smaller, right? The dollar benefit is smaller. If you're disclosing this position and hedging against penalties, all you're really talking about here is maybe the cost of dealing with an audit. So if you lose the audit completely in a worst case scenario, right, you're talking about out-of-pocket fees for an audit. But if you win, or even if you settle on some in-between position, I think that would still probably be a net benefit to most cultivators.
Yeah, but you're right. To your point, it is a bigger deal for dispensaries. I think we spoke with somebody just yesterday, and I think he's actually on the webinar, that his internal financial statements had him at basically break even, but his tax liability was 250 grand because there was million plus expenses that weren't deductible under 280E. So here's the answer to another question. I'm not aware of any headwinds of state of California requiring an audit. I don't think that is in the cards right now. I think that state of California is extremely cannabis friendly, other than, of course, the taxes, and they don't want to jeopardize that relationship that they currently have. Another question is do you have ending inventory, or can you expense it? Well, you can sort of write your internal accounting policy how you see fit. The way we discussed it is you can take two approaches and say that all of your costs are inventoriable and you expense your inventory at the end of the period, or you can say that all costs are inventoriable and leave it at that, and calculate some kind of overhead to put in the inventory. And essentially that turns into a timing issue of when you can expense all of your expenses. But at the end of the day, you do get to expense all your expenses, and there's some tax planning surrounding that depending on your individual company's situation.
Right, and to expand on that, Simon, real quick, we actually talked about that with another one of our tax directors here, who doesn't deal in the cannabis industry, but just as a big picture as a whole, what our thoughts were there, and like Simon said, we really think that you could take either approach, but that by including those costs in inventory and on the balance sheet, and then cycling them through as that inventory is sold, rather than just deducting them in the current year, is really more in line with a traditional accounting policy. It's more in line with GAAP. It's more in line with maybe a business purpose, right? Because if you're a producer of inventory and you're trying to determine what each unit of inventory costs, then dumping your costs into inventory, all of your costs into inventory, and allocating those to each unit of production, there's really a valid business purpose there as well. So by going that route, I would say it's maybe incrementally better from a just you're talking about how do we make put ourselves in the best position to survive an audit and potential tax court challenge. I would say that is maybe incrementally better than deducting it in the current year. But again, that's just an opinion and a thought of how do we make sure every fact we possibly can is putting ourselves in the best position possible.
Here's one for you, Jeff. If your entity is a partnership, isn't there also a risk of audit on of paying tax at the highest bracket as opposed to the lower bracket that may apply to the individual members?
So you're talking about the centralized audit regime rules. Yeah, that's a potential. So you could always elect out of the centralized audit regime, which I would recommend, unless of course you can't. If you, for example, have other partnerships as partners, you might not be able to elect out. But yeah, that's certainly a risk. This position, that's a risk for any partnership, really, not necessarily just companies taking this position, but the new partnership rules do require that is if you're subject to the centralized audit regime, those taxes are going to be assessed at the partnership level, and you're going to pay at the highest rate rather than the individual's marginal rate. But again, this position doesn't necessarily change that. Maybe just makes the risk of audit a little higher, but it's really the same rule either way.
So here's answering another question. We have not filed any of our clients' returns, pushing everything into cost of goods sold yet, but we are in the process, mid-filing, and the vast majority of the clients that we've discussed this with directly are going to take this route. There's obviously some people that are more risk averse. But when we go into the details and show them all this detail of how it's directly based on the tax code, we think that there's a very, very strong leg to stand on. And the reason we haven't filed any yet is, to be honest, we just got to the point where we were 100% comfortable with this maybe a week and a half ago, where we said, hey, this is a strong case, and I don't think the IRS has a leg to stand on to fight it.
Right. Well, and in addition to the what, it's the how, right? So the what is what is this position we're taking, but really what kind of cemented this for us was how do we get there, and how do we put our clients in the best position to withstand an audit? It's again, getting that accounting procedure written, signed, and dated. It's things like that. It's making sure that your books and records reflect the method that you're using on your tax returns. It's all of those things. So putting together an internal set of best practices and going through that, right? Discussing the tax shelter rules and how that can potentially kick out some clients from this position. So having those best practices in place is a point we recently got to, yeah.
Here's an interesting question. Will 471C have a significant impact on the political resistance to eliminate 280E? It seems to take the teeth out of 280E for at least smaller entities. And my thought is that big businesses, they want a tax, no question, Republicans and Democrats alike. But they don't want to touch anything that affects small businesses. So I don't think you're going to get political support to take away high tax for large cannabis companies. I don't see that. I don't see that happening.
Yeah, and really this could go one of two ways, right? So one way would be that right, this loophole gets upheld and everyone starts doing it, and then there's a political push to close it and get back to a point where this doesn't work and we're just stuck with inventory rules under 471. And the other idea there is that, well, maybe they see this again, this works, it's upheld, and they just decide, look, because people are already doing this, let's just repeal that anyway. But
Jeff,
if
I think about the timing of when this will actually get to a resolution in the tax courts all the way up, I don't see that happening for a few years, and hopefully by then 280E is gone anyways.
Right. It's going to be a long time before we get clarity on this.
I think that's mostly it in the way of questions, which is perfect timing. So, hey, I want to thank everybody for joining us. We really appreciate your time, and we hope you have a great day. I want to finish off with just one quick poll because I am curious to see how people feel. Okay, I'll put it up real quick so people can see. There's a small percentage that said they're just uncomfortable taking this position, but it looks like the vast majority feel comfortable doing this. And I think that if you have additional questions, you know, to get you to that comfort level, please let us know. We're happy to walk you through any concerns that you might have. Like I said, there's still more to this, and it can get a little bit more complicated when we talk about how to separate entities and you know, ownership interests. But we're happy to walk anybody through this who is considering it. So thank you all again for coming. If you have any questions, comments, or want to reach out to us, our contact information is on the screen. Thanks again, and have a great weekend, everybody.
Thanks, guys.